It's been a long time since I put a video together, and I was going to hold off until the Silver Institute and their partners released their global silver estimates. But at the silver price of $19.15 and a lot of potential to break into the 18s, I wanted to put this video together for moral support and to demonstrate the larger picture at play. So to start off, I'm showing you the break-even price of a group of 12 silver producers. 7 of these companies are in the top 10 producers in the world. What this data shows you is how much the companies are spending per ounce of silver for the period displayed in the charts. Therefore, the numbers can be interpreted as the break-even silver price for a company, or to put it simply, their estimated production costs. The dotted line is there so you can briefly compare the break-even price for this group of silver producers with today's market price for an ounce of silver. Maybe 1 or 2 of these companies can break even at a price of $19.15 in the short run, but most of the represented companies are underwater by several dollars, or for some, much more. So when you average the break-even prices for this group together, you get a pretty decent estimate of where the silver market stands at large. And what is very interesting is that when you compare this production cost data with the price of silver, you get this chart. As you can see, production costs and the price of silver have moved pretty much in step with each other. From a market perspective, this makes a lot of sense as you want prices to be somewhere in between, creating incentive for producers to bring the commodity to the market, and in the opposite end, make the commodity available to the market at a cheap price in order to create growth in the economy. And we do see that in this chart. We have profitable periods and we have not so profitable periods, and we can roughly find it somewhere in the middle. This makes both the economy happy and producers happy. So in 2011, silver prices skyrocketed, and silver producers were reporting $10 to $15 or more in profit for each ounce of silver they were producing. This was at an average price of just over $35 for the year. That's a lot of profit. However, this was harming the economy. Solar panel producers were racing to use less silver in their cells because silver had now become a significant portion of their costs. The same thing happened throughout the industrial world. However, we only saw a 6% decline in industrial usage globally despite the incentive to use less of it. The reason is that silver is used in specialized and irreplaceable sectors of industry. Since 2011, silver prices have been falling hard. This has been cutting silver producers' profits annually, and now we are getting to that awkward price level where there is no longer any incentive to produce silver, as most companies are taking losses. 7 of the 12 silver miners in this group used for this data report a loss at an average price of $23.80 in 2013. The price of silver today is over $4 lower. I would also like to note that these losses were recorded after massive reductions in capital expenditures, office employment, and other non-essential costs. So why are the costs of silver going up, and why can't silver go too much lower? Let's look at the 2 leading drivers of silver production costs. First, the most important driver is energy prices. Energy can be connected to every part of the mining operation, as well as refining and shipping. Silver and energy are directly connected, and we can clearly see that in this chart. The dotted line is the production cost for the 12 producers, and then we also have the spot price of crude oil. When crude oil prices have moved in any direction, production costs followed. So what if oil prices were to get cheaper? Well, here's the thing. Oil prices also need to rise as production costs for oil are going up 10% a year. And when oil prices made their move to this current price channel, capital expenditures were skyrocketing and incentive to produce was going up, even though production, or getting a return on investment for their projects, was declining, as we can also see in this chart. And finally, in this recent quarter, which is not shown in this chart, oil majors have been reducing capital expenditures, despite declining production, as well as having an oil price of $110 a barrel for selling. They are doing this in favor of shareholder dividend returns. The reason is $110 a barrel is no longer enough money to expect a return on capital investment for any of the remaining projects out there. And according to Shell Corp's chief financial officer, Simon Henry, 10 to 15 years ago, when majors took favor of capital returns over capital investments, oil prices began to rise. I can imagine we can expect the same story to happen this time as well. So oil prices are going to rise, and this is going to force production costs higher. Got it. What about the second most important driver of silver production costs? Well, this is ore yields. Ore yields can be described as how much ore needs to be processed in order to get a certain amount of usable material out. And what we can see by these charts by Steve St. Angelo is that ore yields are declining rapidly for the top 6 silver producers. Ore yields have declined 41% since 2005, and total processed ore has risen 65%, all while production has been declining. Another way to consider this information is this. KGHM is the largest silver producer in the world, or at least in 2012, and they yield only 0.004% silver as of 2012. The Bingham Canyon mine, the largest copper producer in the U.S., yields 0.00007% silver. Can you imagine the energy involved to extract silver at 0.00007%? Yikes. So what else can we tell about this production cost data? Well, from 2004 to 2013, silver prices have reflected production costs. Production costs are the foundation for silver prices. They are the balance between producer needs and market needs. We can learn a lot from them. For example, let me show you what we can learn. The dark black line is our production cost data. The dotted line is the best fit trend line to fit into that data. The R-squared value tells you how well that trend line fits with the data. A value of 0 means there is no relationship with the trend line, where a value of 1 means the trend line is a perfect fit. With this exponential curve, we have a value of 0.9244. This is a really awesome fit. I tried using a linear trend line, but the R-squared value is not nearly as high. This means that production costs are exponentially growing rather than growing at a linear rate. So let's add silver prices to this dynamic. So silver prices are trading along this trend line. If the price distances itself too far from the trend line, the price will swing back to reconnect. So in 2011, the price of silver distanced itself way beyond the trend. As we said, silver miners are making a killing. Today, silver prices have swung just as far back in the opposite direction from the trend, and now silver miners are getting killed. So we have silver miners making a killing, and now we have silver miners getting killed. What I see is a yin-yang formation. I'm not really sure if that's a real term, but that is what we have here. We have increased volatility in recent years to reflect the current economic climate. Things are getting worse, and I think this volatility could increase into the future. If this yin-yang formation holds, we can expect price movements that could resemble something like this. Okay, so I was also going to give an update on supply and demand figures for silver, but I was waiting for some global figures to play with. I, however, can show you a couple charts on U.S. supply and demand. This is, in my opinion, the most important trend going on in the U.S. right now for silver. We have dwindling domestic availability for silver, and we have an increasing dependence on a foreign supply to meet ever-increasing domestic demand. In 2011, foreign imports actually composed 70% of supply for the United States. The other important trend going on is this. Silver Eagle sales have consumed the quantity of all USA's domestic mining production, and more. We had a shortfall of over 7.5 million ounces of silver from Silver Eagle sales alone in 2013. The same story is happening in Canada, where silver maple sales are consuming the equivalent of all the domestic mining supply as well. So when we put all this information together, we can get a good grasp of where the silver market is today, and also where the silver market needs to be tomorrow. I hope this was helpful, and thanks for watching.